Hello, this is Dan Perkins, and this is Money in Motion video blog. Today I want to talk to you about one of the new taxes that are going to take place starting the first of the year. It's the 3.8% tax, what the implications are, and what we should be doing about them. As you know, the Bush tax cuts, which were extended, are due to expire at the end of this calendar year. It will be a significant increases in taxes, and both estate taxes and income taxes, starting in 2013. Now, should Mr. Romney get elected president, he has said that he will address the issue of Obamacare and eliminate it or overturn it. But the reality is that he doesn't take office until January 20th. These new taxes go in effect with January 1st. And even then, it would take some time for the president to draft the legislation, get it to Congress, and for Congress to pass it, assuming that there are enough Republican votes in the House and the Senate to pass the repeal of Obamacare and tax reform. I'm really concerned about that, and so I've been talking to you individually about some things you need to do. But for now, let's just talk about the 3.8% tax. This is one of those things that Chief Justice John Roberts, when he interpreted the Obamacare mandate, he determined that it was not a mandate, that in fact it was a tax. Included in the legislation of Obamacare are 12 new taxes that are imposed on people depending upon their income at different rates. The first tax is the 3.8% tax. It is a very, very squirrely tax law because everything is supposed to be based on either $200,000 for a single taxpayer or $250,000 for a joint return. Let's say that you had $250,000 between you and your spouse of earned income, and you had $25,000 in dividends and interest earned on investments. But you also had itemized deductions for your mortgage interest and taxes and other things, which brought your total income to below $250,000. Under that scenario, you would think that you would be exempt from the 3.8% tax, but not true. Since you had $25,000 worth of dividends and interest above the $250,000 gross income number, even though your adjusted gross income will be below $250,000, you still have to pay the 3.8% tax on dividends and interest. Now, the 3.8% tax is not limited just to dividends and interest. You'd have to pay a 3.8% tax on the sale of your home. You'd have to pay a 3.8% tax on the sale of a business if you owned it, real estate, whatever. Point is that some people are saying it's almost like the first national sales tax. Now, I'm not sure I agree with that. I understand what they're coming from, that you're going to have to pay an additional tax. But 3.8% is a significant amount. If you looked at it from the standpoint of what happens to dividends and interest after the first of the year, some people are calculating that with the new 3.8% tax and the increase in the ordinary income rates, that some taxpayers may pay as much as 43% tax liability on dividends and interest. Now, there's some people in my industry who are trying to capitalize on that, excuse me, and they're encouraging people to reposition their portfolio, for example, to buy tax-free municipal bonds. Now, as of this recording, the long-term return on a high-quality 30-year tax-free municipal bond was about 2.57%. 30 years at 2.57 tax-free may sound attractive. However, let's just assume that between your federal and your state taxes, you have to give up 50%, and that's certainly possible that you could give up in certain high-tax states. You could give up 50% of your investment income. So let's say that you had an investment that paid 8% and you gave up 50% in tax. So you give up 4, you keep 4 after all taxes. versus 2.7 after all taxes on the municipal bond, you might be better off to, even at a higher tax rate, to pay the taxes because your income is greater. As it relates to the gain on the sale of the house or a business, in addition to capital gains taxes, you're also going to have to pay this 3.8% tax. This is just one of the things that's going to go into effect that's going to generally raise taxes dramatically. As much as I'd like to believe that Mr. Romney can change some things, I think it will take well into the first year, if he's elected, to make any substantive changes. And I don't think the Congress is going to make the tax law changes retroactive to the first of the year. Could happen, but perhaps not. So, markets, by the way, have been have an upward bias. However, I believe we're running into resistance within the trading range of what I said, 1420 to probably 1085 on the S&P 500. And so I would be looking to raise some cash if we got back to the 1420 level, and looking to redeploy it if we get down to the 1087 level. I expect volatility to continue throughout the fall, especially after the conventions are over and we have clear designated president and vice presidential candidates. Things could get a little rough. So hang in there. We're getting paid while we wait, which is very important. And thanks for watching. And if you have somebody that would like to talk to somebody about changing their portfolio or getting more out of their money, please feel free to give them my name and number, and I'd be happy to talk with them. Thanks for watching. Take care.